My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Another day, another rally where stocks, frankly, go up on nothing. The Dow gaining 251 points, S&P jumping 1.64%. The Nasdaq screaming higher, finishing up 2.56%. Sometimes stocks deserve to go up on nothing, but it still seems a little quizzical to see stocks levitate like they're doing here. Now, there are three main ways that stocks do go higher. You can have better than expected earnings, all right? And we understand that. Second, you have what we call self-help. That could be selling your business, breaking it up. Third, hype. Never mind, we call it multiple expansion in business. Meaning we're paying more basically for the same level of earnings or story, betting that someone else will take it off our hands for a price that's still higher. Okay, some people call it the greater fool theory. Multiple expansion is what we saw today when Wall Street got hyped about the best of the best. Look at what led us higher. Start with Apple, okay? And it's always fun to start with Apple because you know how much I like it about. You follow Apple. I follow Apple. We all know that they launch a new phone tomorrow. I mean, you got to be under a rock not to. It's the ultimate non-event event because new iPhones come out like clockwork, so everyone has them on the calendar. We all know what's going to happen. We know there'll be a mix of positives and negatives about size, weight, cost, color. That always is the case, even with 5G in it. And then we end up buying it, of course. It's almost a dog bites man story. Yet that didn't stop Wedbush's Dan Ives, nice person, publishing a piece titled, "The Grand Entrance for iPhone 12 Begins. Cook kicks off Super Cycle Tuesday." He calls it the most important launch in 6 years, before describing it as a once-in-a-decade product launch. He points to stepped-up demand for components for the larger version, which is true. We know that from Marvell. We know that, by the way, Skyworks Solutions will probably have an upside surprise. And he says that China's the linchpin of this whole thesis. Again, dog bites man. Let me read you one, pertinent snippet. Quote, "Cook and Company have the stage set for a super cycle product release, which should drive shares further, in our opinion," end quote. Well, a super cycle, huh? Listen, when you call something a super cycle, you're going to catch people's attention. Unfortunately, I'm superstitious about super cycles. That word's the ultimate jinx. We heard about the coal super cycle in 2011, right before the entire coal industry crashed and burned. It was a once-in-a-lifetime collapse. In October 2014, Morgan Stanley called for a fracking sand super cycle. That was almost exactly where the price of oil peaked, kicking off a multi-year meltdown to sand fracking, or fracking sand, or whatever. So when this analyst talks about an iPhone super cycle, I feel like he's tempting fate. That said, I like Apple. I think you should own it, not trade it. But people are going to buy it today and they're going to sell it tomorrow because it didn't go higher again. We've seen this time and again. The bar has now been set so high going into the launch that there's a good chance Apple will disappoint today's buyers. The darn thing rallied more than 6% today. Talk about great expectations. Siri, will the stock go still higher? Quizzical. Then there's Amazon, which jumped almost 5%. Unless you're living under a rock, you know tomorrow's Amazon Prime Day, which is actually 2 days this year. Go figure that out, right? We're in a pandemic. We know there's going to be a ton of shopping. But why not wait? But that's not how John Blackledge at Cowen sees things. Today, he jumped the gun and gave you a preview that's outrageously bullish on Prime Day and the extended holiday shopping. He's expecting a demand surge, which suggests a permanence to shifting consumer behavior. Yeah, I know. Like, today you have to say it? Do you really have to say it today? I mean, again, there's nothing wrong with this piece. It's just that it brings nothing new to the table because everybody kind of knows this stuff already. Personally, I think it would have been better to say nothing because now the stock has roared ahead, and it'll be harder for Amazon to live up to the Prime Day hype. And you can see some of these analysts saying downgrading, trimming numbers, doing something negative because they're let down by Prime Day. That's the kind of stuff that happens on Wall Street. Next up, have you noticed that the stocks of Google and Facebook have been lagging their smaller competitors like Snap or Pinterest? Well, Lloyd Walmsley at Deutsche Bank noticed, and that's why he's pounding the table on both winners today, sending them soaring. Walmsley says he prefers Google because it's been a laggard, even as Facebook has a big fourth quarter e-commerce product cycle, though he still recommends buying them both. Now, just like with Apple and Amazon, I mostly agree with this guy. I like Google, which is up only 17% for the year, but it has a habit of disappointing investors when it reports. I was hoping that for once the expectations would be low enough to be easily beaten. With this kind of hype, that's a lot less likely. Honestly, I'm hoping the government breaks up Google's parent company, Alphabet, because I think the sum of the parts is worth more than the whole. Google, Cloud, Waymo, YouTube, Search, and the health business, they'll all be better off as standalone companies. One of the few cases where overzealous antitrust enforcement could actually benefit shareholders. As for Facebook, I love the Shops initiative that's boosting small and medium-sized businesses. Have you noticed how much of the heat's died down since Facebook became an e-commerce facilitator? I think it's brought the company a ton of goodwill to be with small and medium-sized businesses. That said, there's nothing in this research report to boost numbers. It's just hype. I don't know about you, but I was already hyped about Facebook. I'm a little less hyped with the stock up 4% today. How about another piece by a Deutsche Bank analyst, Taylor McGinnis? There's a great name, Taylor McGinnis. Now, talking about Microsoft Cloud business, Azure, and quote, the checks came back more mixed on deal activity, and that made me nervous. But then McGinnis says not to worry. Given the durability and fundamental strength of Microsoft and tailwinds from the work-from-home phenomena, we continue to believe it will weather the storm better than most of its software peers, and we remain bullish. Hey, I like Microsoft too, but the only actual news in this piece was negative. Doesn't matter. Stock rallied 2.6%. Look, I don't want to pick on Deutsche Bank today, but the truth is it was responsible for a great deal of the tech rally. Walmsley, the guy who likes Facebook and Google, also recommended Twitter with the catchy phrase, "Come fly with me." This is written by Sinatra. Upgrade to buy and raising TP. That's target price, by the way, not toilet paper. Now, I always love Sammy Khan, but I never expected one of his songs would work into an upgrade. This piece openly acknowledges that it's what we call a re-rate, meaning Twitter's finally starting to get respect for its turnaround. The analyst doesn't want to miss the boat. When you see re-rate, that's also code for it's the same company, but now people are starting to pay for it more than they used to. Again, not wrong. I've been saying Twitter's radically undervalued for ages. It's nice to see someone else acknowledge that. But the stock surged 5% today. Without another upgrade, that kind of move will prove to be unsustainable. Now, it's not all tech. Wendy Nicholson, one of my absolute favorite analysts, top flight, over at Citi, upgrades PepsiCo from hold to buy. I read through the note, and it's one of those pieces that says, enough with the stock's underperformance. It's gotten too cheap versus the rest of the group. The title is literally, after 5 years of relative underperformance, we think now is the time to buy Pep. She gives it a $169 price target and is betting the stock will play catch-up. Give me some relative outperformance. Me, I don't want relative outperformance. I want absolute performance. And I'm not getting it from this piece, even though, once again, I mostly agree with Nicholson, which is why we own PepsiCo for my Chapel Trust. Bottom line, today's rally really was based on hope and hype, not new facts. Can we go higher? Sure. But these prices are thin reeds that make me want to pull my horns. When everyone starts agreeing with you, and they agree with me on every one of these calls, but much higher, well, that's when you need to get more cautious, not more exuberant.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.